Hey, what's up, my friend? So, in today's episode, I want to talk about why you don't want to be chasing breakouts in the market. That is for losers, right? Do this instead. So, what is this thing to do? So, first and foremost, right, let me talk about why you don't want to chase breakout. So, here's the thing. When the market breaks out and it moves a lot, right, within a short period of time, and if you want to chase those type of breakouts, the problem with it is that you don't have a logical place to set your stop loss. The market has moved too fast, too soon, and the nearest market structure, for example, let's say it's a bullish breakout, the nearest market structure like, support or swing low, it's very far away, it's done far away. And if you are going to have such a huge stop loss, okay, you have to reduce your position size. If not, your risk, right, will be, out of whack, right? And if you reduce your position size, it's going to take you a very, very long time before you even hit a 1-to-1 risk-reward ratio. So usually in market conditions like this, when the market has already exploded, right, it's too late to enter the trade. So don't chase this type of, market move. It is not worth it. So what should you do instead? Well, you can do one of three things. Well, I wouldn't say one of three things, right? In fact, these are three possible scenarios, right, that you can look to trade after the market has made a huge move. Number one, you wait for the first pullback. So what this means is that if the market breaks out, okay, there's a good chance that it will stall. It cannot go up forever, right? Eventually, it needs to take a breather, rest a while, take a break before, making the next breakout. So in this type of scenario, if the market is in a strong trend, you'll notice that the price starts to consolidate, forming something like a bull flag pattern. However, you also want to be careful that, you don't enter too early. So this is where the 20 period moving average can help, right? You want to let the 20 MA catch up with price, because by the time the 20 MA has caught up with price, that's where the market has already consolidated for a while, usually about 7, 8, 9, 10 candles. At that point in time, right, after the market is consolidated, then hey, now, right, it's telling that it's getting ready to break out higher again. So what you can do is just to simply buy the breakout of the swing high. So that's the first thing you can do, right? Wait for the first pullback. Number two, sometimes the market, right, it doesn't give you a nice tight consolidation to buy the breakout. What it does is that it retraces, right? It retears back the previous resistance turn support. So means, for example, imagine the price breaks out of resistance, right? It moves higher, and then it retraces down lower and retears back previous resistance turn support. So hey, no worries, right? Now it came back to the original breakout point. You can look for buying opportunities at this area, right? You can look for stuff like a bullish price rejection, hammer, bullish engulfing pattern, stuff like that, showing you that the buyers, right, are about to come in and push the price higher. So that's the second way that you can trade, right, to let the price retest back the breakout point, or rather, the market structure where it broke out off earlier. And number three, what you can do is sometimes you don't get a pullback. Sometimes you don't get a retest of the previous market structure. Instead, what it does is that the market goes into a range. It forms a new range. Okay, so you can imagine that the price, it breaks out, right, and it forms a new range, right, higher above the breakout point. So when it forms a new range, what you can do is that you can start to identify the highs and lows of the range. So if you're bullish, you want to be buying near the lows of the range, right? You can look for simple stuff again, like a false break setup, a bullish price rejection at the lows, right, to get long, right? And after which your stops, right, can just go a distance, right, below the lows of the range. So that's another way that you can look to trade this market, right, without chasing the breakout. And finally, the fourth thing, right, which could also happen, is that the market goes into a range and it doesn't retest the lows of the range. Okay, maybe it just didn't come low enough, and instead if it comes near the low of the range, then it bounces up higher, then it retraces down slightly lower, bounce up higher, right? At this point in time, you can imagine that the price is forming something like a ascending triangle, a series of higher lows coming into this new form, swing high or resistance. At this point now, you have somewhat of a build up that is forming, right? Something similar to the pullback trade that I mentioned earlier, but this time around it's more of a longer term consolidation. And again, you can look to buy the breakout of these new highs, right, in anticipation of higher prices to come. So you can see that you don't have to chase the markets. There are many things that you can do, right, to catch the next wave of the move. I think what's important is to understand, right, what are the possibilities that could occur, and then prepare yourself for those trading opportunities. Sounds good? Okay. So with that said, I have come towards the end of today's episode. If you've enjoyed it, right, hit the thumbs up button, subscribe to my YouTube channel. The button is below. Click ding, subscribe, and I will talk to you soon.